Have you been looking to buy or sell a house recently? Even if you're not, I'm sure you know the coronavirus crisis has had an enormous impact on the real estate market. So will it get better? Will it get worse? And what does it mean for your retirement? It's that time again, time to tune out the hype and focus on the facts. Of course, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. The housing and real estate market is one of the most important sectors of the economy, and its overall health plays a major role in the retirement plans of most Americans. Selling a home that's paid off, buying a second home, downsizing to a smaller home or apartment, or even investing in real estate. These are all common goals or strategies in many retirement plans. But will some of your own plans have to be abandoned or changed due to the possible long-term impacts of this crisis? Or are there new opportunities emerging in real estate that you might want to be able to take advantage of depending upon your situation? We'll explore those questions and more right here on today's show. We'll also discuss how the fortunes and misfortunes of the real estate market can directly impact your retirement strategy in other major ways. Also, we'll get a fresh perspective on the economy from the markets overall, that is, from author, options trader, and entrepreneur John Najarian. Finally, as always, we'll get insights from my co-host, Jeff Small. But before we bring out Jeff, let's take a high-level look at how the real estate market was first impacted by the pandemic and where things stand now. The COVID-19 virus was declared a global pandemic by the World Health Organization on March 11th. As with most areas of the economy, the immediate impact on the housing market was chaotic. Sellers quickly pulled their listings. They pulled their homes off the market or decided not to put them on. New construction came to a halt. As millions began to lose their jobs, programs emerged to allow homeowners to temporarily suspend mortgage payments. Now that caused some lenders to panic and to tighten their standards and essentially hit the brakes when it comes to approving loans. Meanwhile, some states deemed realtors to be essential, allowing them to continue showing homes while others didn't. In the midst of all this chaos, by mid-April, the number of homes under contract had dropped some 43% nationally, and this according to the real estate company Redfin. A house or property is under contract when a buyer has made an offer and the seller has accepted it, but the sale isn't yet final. So that shows that this drop came quickly and dramatically as the crisis hit the housing market. Now, as you recall, the impact on the stock market was just as fast and dramatic, with the market losing almost 40% of its value within 2 weeks of the declaration of a pandemic. By mid-May, the chaos was subsiding as states slowly began to relax social distancing measures and realtors adapted to the situation. Virtual open houses and drive-through signings became common. In some cases, a, quote, COVID contract was even created. This allowed buyers to walk away if they had bid on a house without physically visiting it and then ending up not liking it when they saw it in real life. Despite these workarounds and a slightly less chaotic market overall, a more recent study shows just how widespread the impact of the pandemic has been and what it may mean for the future. A study by OJO Labs found that a full 80% of would-be buyers have either delayed their housing search indefinitely or stopped it altogether. Now, obviously, if 80% of potential buyers remain out of the real estate market long term, that has enormous implications for anyone looking to sell their home as part of their retirement strategy. If you're one of the 65% of Americans who own your own home, odds are it's one of your most important assets, if not the most important. Now, in addition to all these issues, there are also some concerns, new concerns in fact, about a potential huge spike in defaults and foreclosures in the months ahead. This can happen as laid-off workers and hard-hit businesses struggle to pay their bills. Naturally, the ripple effect from that could hit every corner of the financial markets as it did in 2008. So can the Federal Reserve prevent it this time with some of the same measures they used during the financial crisis? We'll talk about that more right here, coming up in just a bit. Right now, let's welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also the brand ambassador for the Retirement Income Store and best-selling author of the Amazon book Turning Financial Planning Right Side Up. Jeff, all right, real estate, is this going to be a prolonged trough? The stock market has recovered 80%, seems not to be phased, but how about the real estate market? Do you think it's going to be the same? I mean, it hasn't been the same. The real estate market is still dragging through the mud a little bit. It's slower than it was by a good margin. But do you think we'll see a huge spike up by the end of the year, or do you think this is going to be a much slower recovery?
Well, I think it's going to be a migrational recovery, Dave. What's going to happen is people are going to move from the densely populated areas into the suburbs to have more space. And we're seeing that happen in Florida, where people from New Jersey and New York are already relocating as a result of the pandemic. So I think the bigger cities, the denser populated areas, are going to have a little bit more problems with their real estate markets. But the external markets outside of those areas are going to do very well in this rate environment, because rates, let's face it, I mean, it's a buyer's interest rate right now. Rates are really, really low. And if they go lower, that'll just juice it up even more.
Well, that's an interesting point. I hadn't even thought about the fact that we could see real estate prices stagnant in the big markets for a long time and then have real estate markets in the suburbs and smaller communities increase. I hadn't really thought about that. And part of that has to do with people being able to work from home, not having to go to the big city anymore. And I want to talk about that in a minute. But before we get off the residential topic, though, a big part of that really has to do with whether the banks loosen up credit. Because, I've got a key employee right here, for example, that makes a very good income, is very good credit worthy. And, because the interest rates came down, he tried to refinance his house. And the interest rate they were offering him was significantly higher. Even though interest rates in the treasury yields and all that have come down, his rate was higher. And for others, I've heard horror stories about how they've totally tightened up the credit standards, much like 2008. So this is why I get concerned about negative interest rates. That has to change. That has to loosen up. And the Fed, lowers rates to zero. And if that's not enough motivation for banks to actually lend out money, now if they go to negative interest rates, essentially they penalize banks. They say, okay, if you're not going to lend it out, you have to pay us the Federal Reserve interest. So are negative interest rates now back on the table, if you think about that?
Well, I think negative interest rates are only on the table once we find out what the settled economic growth rate is going to be, not the anticipated one that the markets reacted to the last 60 days, but what the real growth rate is going to be the next 5, 10 years in the market and in the economy. And then we'll see what the Fed does with interest rates. But for now, we're going to hover below 1% to 50 basis points, 0.5% on the 10-year note. We're going to hover in that range. The interest rates aren't going to move. They can't go negative too early, Dave. They got to play that card if they need it.
Well, I agree that, and Powell's trying to do that 100%. My only concern, of course, is that if banks don't start lending in spite of low interest rates because they tighten the standards so much, the Fed has to do something to force them. And I know across Europe, at least, negative interest rates have been that tool. So I think, as in the past, as you and I have settled debates through our guests, I think this is a good question for our good friend John Najarian that's coming up in a minute. I'd like to see what he thinks about negative rates. That'll be an interesting one. How about commercial? If people are moving to the burbs because they don't have to go in the city to work in the offices anymore, then companies need less office space. So what does this do to commercial values in the commercial market?
Well, there's another conflict there because now we're living in this age of social distancing. So big commercial firms are looking for, 6 foot of adequate space per person to maintain a distance. So it could potentially take up more space for big companies who folks, if they can't work at home and they've got to be on site. So more demand for commercial space might go up because of that if the pandemic goes on for a period of years. And so we just don't know. But what we do know is the economy is going to contract. We're not going to have the same growth rate the last 10 years. And that should put pressure on the commercial real estate space. In general, we see that those areas contract, and sometimes they contract quite heavily when the economy doesn't grow at all.
Most of our viewers and listeners, of course, aren't out there buying commercial buildings or strip malls, but they do buy commercial property through real estate investment trusts, through REITs. And I know we're a little concerned that we don't think we've seen the worst of the carnage yet in real estate investment trusts, and really trying to find the best opportunities there, because that could go either way. And to me, that has more risk than residential, because residential, it's always the American dream. And even though younger folks today don't care as much, they're happy to rent, but still, it's still the American dream. And I think as people get older and have families, they're going to want to buy. But I like your point that we might see some downward pressure on prices in the urban areas, and maybe some more support in suburban areas. But how about places like where we live? How about places like Florida? You can argue that it's the second homes that are the first one to go away when the economy gets tight, but you can also suggest that there's pent-up money, there's pent-up wealth that would love to buy a second home in a place like Florida that might go fishing for good deals. So how does that play out?
Well, I think that those types of markets are going to be rock solid, Dave. The only thing that causes a price implosion there is a lack of demand or an escalation in foreclosures. And that will put downside pressure on prices. And we just don't see that down here. It's not going to happen. There's only so much land in the land of oranges here in the Sunshine State.
Yeah, and this is really, the wealth disparity is increasing, sadly, through this crisis, because the people who have money are fine, they're even better, and the people who don't have money are the ones that are worse off. And if you think about it, if the people that have money that are coming down buying second homes, buying vacation homes, I think you're right. That demand, we're seeing a little decrease in the demand now just out of fear. But I think some of those vacation destinations, second home destinations, could have the best chance of a solid rebound. So again, let's see what our good friend John Najarian thinks. But for now, before we get John on, we need to take a quick commercial break. You stay with us. We'll be back with more right here on The Income Generation. We'll be back in just a moment. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free Retirement Income Kit. Call 888-888-4176 now.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
As everyone knows, the collapse of the housing market was actually at the heart of America's last major economic downturn just over a decade ago. As everyone also knows, the Federal Reserve intervened in the crisis with a host of emergency measures, some of which were unprecedented. While the cause of this crisis is quite different from the last, the impacts to certain areas of the housing market are similar in many ways. And as a result, the Fed's response to the crisis has included many of the same provisions and programs that it used during the financial crisis. And in most cases, they've been expanded. Here are four of them. First, and most obviously, the Fed has again dropped interest rates virtually to zero. Of course, we're talking about short-term Fed funds rates. Doing so helps to decrease mortgage and home borrowing costs, which should theoretically lead to more home loan borrowing, real estate investments, and residential home sales. Second, the Fed has resurrected its Troubled Asset Relief Program, known as TARP, to lend money to holders of mortgage securities. In fact, in 2008, TARP was used to stabilize many areas of the market. It included measures to help families avoid foreclosure and to encourage banks to continue lending within the housing sector. This time, TARP's reach has been expanded to include securities based on commercial mortgages. Third, more bond buying, aka quantitative easing. One goal of which is to reduce long-term interest rates, such as mortgage rates, directly. Since bondholders tend to also hold mortgage-backed securities, the Fed buying them in large volume theoretically drives up demand, which drives up prices, which drives down yields. The reduction is then passed on to consumers, in theory, in the form of lower mortgage interest rates. The intention, obviously, is to promote housing and commercial real estate transactions. As we've talked about many times on this show, the net result of this artificial intervention by the Fed since the financial crisis really, I believe, has yet to be felt. I believe it's helped create an age of unprecedented economic uncertainty and made asset protection even more important than ever before for investors over the age of 50, those of us who are part of the income generation. And finally, the Fed has also revived an expanded version of its term asset-backed securities loan facility known as TALF. So we had TARP and now we have TALF. One of its goals is to ensure the flow of credit to borrowers, developers, and buyers of commercial real estate. So can these and other efforts keep the real estate market from fully collapsing again? And if not, what does it mean for the recovery and the financial markets as a whole? We'll be covering this more coming up in just a moment. But right now, let's bring back in my co-host, Jeff Small, along with our guest and good friend, John Najarian. John's the author of the new book, Follow the Smart Money, along with his brother, Pete. He's also co-founder of Market Rebellion. John, thanks so much for being back on the show with us.
Great to be with you. Thanks, David. Thank you, Jeff. I'm looking forward to it.
Yeah, so it was about 9 weeks ago we last had you on the show. And I just have to say one thing. You were right. You're right. You said you thought the bottom of the market was in, unless there's a huge second wave of infections. You thought things would go up. But let me ask you, are even you surprised about the extent to which the markets have recovered and how quickly they've recovered?
I don't mean to sound cocky about this at all, Dave, but no, I am not surprised. I think the people that were most surprised are my colleagues that are based in New York City, because as wonderful as New York can be, it was the center of the pandemic in the United States. And hearing those sirens every night and knowing how many people were getting infected, were going into hospitals, getting on ventilators, they had a very different view of what this pandemic was doing to the country, because they basically thought that's happening all over the country, and it wasn't. And as parts of the country, then Dave and Jeff, began to unlock, began to reopen, which in some parts of the country now is going on 5, even 6 weeks. As that happened, New York was just shaking their head collectively saying, oh my God, we're all gonna die. And nobody will go out ever again to a theater, to an airplane, to a hotel, to a cruise line. And that's where they were dead wrong. So again, not cocky on my part, but I'm lucky that I don't live in New York, because like you guys, I get a perspective of other parts of the country, not just New York City. A lot of my New York-based friends only have that New York state of mind. And that was the wrong view of the rest of the country. So to see us come back, to see jobs make that huge turn from an expected, loss of 8 million jobs to actually creation of jobs of 2.5 million or whatever, those sorts of things shock New Yorkers. And it doesn't so much shock me, because I know a lot of people who were going back to work personally, and yet in New York, they didn't know anybody who was going back to work.
It's funny, you're right, it's a regional thing. At first, when the president said each state has to make their own decision, I thought that was a bad decision. I thought he was just passing the buck to the states. But now I agree with you, it's so regional that really that was the only way to do it. So I guess the question now, I know that Jeff is dying to ask, is about the future. Jeff?
Yeah, so John, this question really is for our listeners and our viewers. And so we've really reached the moment of peak impact with the great unemployment numbers we had, that $9 million swing in a month, combined with the Fed stimulus and the fiscal stimulus. If you're an average investor today, is there more upside to the market, or is there more risk? Talk to them. What would you tell them today if they asked you that question?
Okay, Jeff, and it is a great question, and it's one that I think the three of us probably wrestle with a lot too. Clearly, with the market 40 some odd percent off the lows, I think I would be dumb if I said, oh, it's not more risky now. It's more risky than when the Dow was at 18,000. Now that the Dow's, pushing back, into the 25, 26,000 range, I'd be dumb if I said, oh yeah, there's less risk. However, with 2.3 trillion coming from Congress in the form of various supports for hospitals, for testing, for mom and pop businesses and things like that, those augmented checks that people are getting for unemployment. And then from the Fed, that other $3 trillion that's coming from the Fed, none of us are going to dismiss that 5 trillion to maybe, if it gets levered, more than that, more than $7 trillion that's basically chasing capital. That capital is chasing, it's looking for yield. And I think that is why, even though there's more risk, there's a bigger support under where the market is right now than there was when we were initially on that drop, falling to 18,000.
So John, 45 seconds left. So bottom line is you believe that even at these levels, we still have a little bit more upside potential than we do downside risk today.
Yes, and stocks like Apple, where they've got a breakthrough technology, 5G, that's going to be coming in their new handsets. We virtually know that, and we know it's going to be announced. I'll tell you, right around the 10th of September is when they usually do that. And that will be a game changer, and it's going to move a lot of different markets, AT&T, Verizon, a lot of the component makers for Apple, and of course, Apple itself.
After the commercial break, I want to talk to you briefly about which sectors. It's clearly more of a stock pickers market than it is an index buyers market. So I want to ask you about which sectors, because you were right last time. So I'm hoping you're right again. Give us good advice. But we need to take this break right now. You stay with us. We have much more coming up from our good friend John Najarian right here in just a moment. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free retirement income kit. Call 888-888-4176 now.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
So are we looking for a short-term dip for the housing market and the real estate market, or another full-fledged crash like 2008, or something in between? Well, as with everything else related to the coronavirus pandemic, the answer is that we really don't know yet. Too many questions about the health crisis at the heart of the economic crisis have yet to be answered. However, there are basically two possibilities. The optimistic scenario is that the virus is contained in the reasonably short term, immunity starts to build in the population, and the economic reopenings continue to expand. If that happens, realtors will start showing homes again in person, as well as commercial properties. Hopefully, the 80% of potential buyers who pulled out of the real estate market when the pandemic hit can then begin to re-enter it once again. Home building in this optimistic scenario will pick up again. And that means lending and borrowing, of course, will have to increase enough for the Fed to be able to dial back some of its efforts and possibly even eventually start raising interest rates slightly again. People who are laid off and struggling to pay their rent or mortgage bills will get back to work and back on track financially, and a rash of foreclosures will be avoided. Clearly, this is the perfect scenario that Wall Street's been hoping for. Why else would the stock market have recovered so significantly since its initial drop back in March and be clinging to that recovery? Of course, the not so optimistic scenario is that the health crisis drags on and it undermines recovery across the entire economic spectrum, including housing and real estate. If cases continue to spike all summer or another major outbreak occurs in the fall or winter, then none of the outcomes mentioned above would seem likely. Rather, realtors would again be limited in their ability to host live showings. Potential buyers who've pulled out of the market could very likely stay out of the market for longer. Lending and borrowing could remain soft or possibly get even tighter in spite of all the Fed's efforts. And at that point, we might just end up seeing negative interest rates. Perhaps most concerning is the potential for prolonged business closures and layoffs that can result in a wave of defaults and a wave of foreclosures. Now, obviously, much of what the Fed is doing now is in an attempt to prevent that possibility. In the end, the government certainly has some control, but they really don't have total control over the virus. In fact, no control over the virus, and certainly not total control over the economic impact. Even without another major outbreak, it's also possible the pandemic has already caused enough systemic damage to the economy and to the markets to make a prolonged real estate recovery inevitable. In the end, I believe the bottom line for all investors over the age of 50 is this: focus on asset protection, focus on retirement income, and prepare yourself to take advantage of this potential new norm and all the new opportunities that might emerge along with it. And we'll be talking about some of those coming up in just a bit. Now let's welcome back co-host Jeff Small, along with our good friend, author and options trader, John Najarian, co-founder of Market Rebellion. John, thanks for sticking around.
Sure. Thank you, David. Jeff.
So I've got to spend at least a few minutes, even though you're not a real estate guy per se, you're a market guy. But the show's about real estate. So when we spoke 9 or 10 weeks ago, you said you don't think the Fed's going to go negative interest rates. But a lot of studies today show that a lot of real estate buyers have come out of the market and they're sitting on the sidelines. So what happens if that doesn't come back? To me, the only way to really get that moving is to have, essentially, is to have negative interest rates. Because right now, the carrot of having banks, have essentially earning no interest when they put money at the Federal Reserve is one thing. But they might need the stick of actually having to pay money on their reserves so that they actually make these loans and get the market going again. Do you think the chances have increased at all of negative interest, or do you think they've decreased?
I think they're about the same. They're still, I believe, quite low, the chances of negative interest rates, Dave, but that doesn't mean an impossibility. When Jay Powell was before Congress this week and he was talking about, we have not exhausted all of the things that we can do. They did ask him about negative rates. He said he didn't think that was some place that we'd go, but he said, basically it's all on the table. Anything's possible. You and I would say that when you look around at businesses, many of which might have fewer people working there in the home office, and a lot of them might be working instead remotely, you don't need as much real estate then. So I think that kind of office space development is something that I would question as to whether I want to be too much in that. But I like other plays in the real estate space a lot, like Store Capital, for instance, STOR. This one's a place that basically they go to the person that has that CVS and they say, okay, wouldn't you like to cash out of that building and instead rent it from us? And now you have more capital to put another CVS or Walgreens or whatever it is. In other words, I think those kinds of places, rather than office space, are where I want to focus for real estate. Yeah. That, of course, and residential.
Good point. And you're right. The demand decrease of demand is one thing. I guess I'm more concerned about the fact that lower interest rates doesn't necessarily translate to more lending, because the credit risk, perceived credit risk by the banks go up, and sometimes they just pucker up. And to me, that would be the one time when we might have to see negative interest rates, because somehow, some way, the Fed would have to force the banks to part with some of that money. Jeff?
You know, this negative interest rate conversation, I disagree with Dave. You know, it really depends on what the settled rate and economic growth is going to be the driver of that. But a lot of people buy real estate, John. They buy real estate to create rental income. And so no matter what rates are, real estate market is going to be good. At least it is in Florida right now. Maybe not in New York where people are migrating. But do you think today, shifting the conversation back to investing, that if you're over 55 today and you're within retirement or retiring, that it makes more sense to be dependent on solvency through fixed income creation to create income, so they're dependent on solvency versus equity growth or economic growth going forward? Should a retiree today or pre-retiree have investor balance there, John?
Sure, I think they should, Jeff. And like I said, I think that residential real estate, in particular in no tax states like Florida, like Texas, like Nevada, are still going to be great investments. And I'm not talking about single family homes because of, you know, a one-off thing like that. I'm talking about, you know, 200, 300 unit buildings that if you have the opportunity to invest in some of those sorts of opportunities, I think those are the ones that really see, you know, the millennials still don't want to buy. They want to rent. They want experiential. They're going to ride in Ubers and they're going to rent their place. And obviously in a state like Florida, I think that continues to benefit from the great climate, from the great business climate as well. And that those kinds of opportunities in residential are where I'd like to be.
And average investors can indirectly get involved in some of those investments through private placements and other such things. But last 30 seconds, you were right when you talked to us about what sectors, what industries would do best. You were right over the last 9 weeks. What do you think over the last couple of months the best sectors are going to be?
I think you stick with tech, quite frankly. I mean, Zoom, ZM
5G.
For the meetings and things like that. People think, oh yeah, it was just a flash in the pan. No, not when you're doing 300 million people on various Zoom calls, up from 20 million when the year began. I think those kinds of things, CHGG, which is basically high school and universities online, that allow the professors to, you know, work with the students and things like that. These are things that are going to continue going forward. It's not like when we reopen, they just stop. So technology in particular.
You mentioned the 5G too. I kind of had a feeling you were going to say that after the 5G comment. John, whenever I talk to you, I always wish we had more time, but unfortunately we're out of time. But thanks so much for being back with us again. Love to have you back in a couple months and get some more words of wisdom from you then.
Look forward to it. Thanks, Dave. Thank you, Jeff.
Very welcome. And you stay with us too. We'll be right back here in a moment on the Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, and I'm here with my good friend and co-host, Jeff Small. So, Jeff, it's interesting. John talked about real estate, and he talked specifically about a real estate investment trust that's in a particular niche. And I think as a stock guy, that's probably a good recommendation. But I don't know, to me, real estate in general, kind of about the bigger crux of the show, I think it's really simple. If you want to buy a bigger home, right now, you're going to sell a smaller home at a loss and then take a bigger hit on what you buy. So essentially, if you're buying up, it's going to be a good thing. If you're trying to downsize, like a lot of our income generation members, then you're going to take a bigger hit on the big house you're selling and get a smaller break on the house you're buying. And as you and I talked about back in the first segment, if you're buying a vacation home, a second home, and you've been chomping at the bit and waiting, it could be a great time to get a good deal if you're patient, right? Is that how you're kind of sort of seeing it overall?
I guess, Dave, I mean, it's all a supply-demand issue. And so if money is cheap right now. If you can qualify for a mortgage, if you have enough debt to equity in your ratios, you can get your mortgage done. It's very easy to do that still, even though banks are still tightening up pretty hard. But banks really want to start lending now as the economy starts to pick back up versus when rates even get lower and their margins get smaller. And so, unfortunately, I think that's where we're at today.
And John agreed with you. He doesn't think there's going to be negative interest rates. He thinks there's more of a chance there won't. So I'm outnumbered 2-1, but I'm still going to keep my stake in the ground here because I just remember back in 2008, in spite of what the Fed did, banks just weren't necessarily lending the money because they perceived there to be too much risk. And my concern is that might happen again. And I don't know, maybe I'm missing something. Maybe the Fed has tools, I don't know, but I'm afraid that the only tool I know of to really kick the money out the door with both feet is for the Fed to go negative interest rates so that the banks actually have to pay money to keep money on reserve at the Fed. That's my thought as far as negative interest rates are concerned. But you win because John sides with you. How's that?
Most guests normally side with me, Dave. That's par for the course.
Most guests like that, like John, I would say it's a stock market cheerleader. Of course, you're going to say there's more upside in the market than downside. But John's never really been a stock market cheerleader because being an options guy, he doesn't care if the market goes up or goes down. He can make money on it, right? So when John says he thinks there's less downside risk still in the market, the stock market, than there is upside potential, I tend to listen because of just the angle from which he looks at it.
Well, Dave, if you remember the question I asked him, I said that he was, for the average investor, retiree, pre-retiree, 55 plus, should they be looking for the market to have more upside, or is there more risk in the market? And he said, his words were, he'd be dumb to say there's not more risk in the market. Did he not say that?
He said more risk than back in March. But at the end of the day, he said that he still thinks there's more upside than there is risk. That we haven't hit that equilibrium quite yet was kind of his final comment with the whole thing.
Yeah, so I mean, he's not a stock market cheerleader, so he's calling it based on what he feels the pulse of the markets are going to be. Even though we have the lingering threat of the pandemic and news coming out of the globe or news domestic, any spike in the virus, and that will impact the markets. Yeah.
And the tech sector, of course, and of course a lot of our viewers, a lot of our listeners, you and I know we never tell people to go putting a lot of money in the FANG stocks, the Amazons and the Netflix and the Apples and all that. But I still wouldn't recommend that, but I guess I have to agree when he talks about technology continuing to be strong. And that seems to make sense for people that want to play the markets a little bit when they've satisfied their income needs through other sources. That's a good sector. I mean, do you agree or do you see it different? Do you see other sectors that you like better than technology over the next month or 2 months?
I agree. I agree with that. I think, but when John talks like that, what is he really saying? He's telling us how he's investing. He's walking his talk. So we know he owns calls and probably a lot of those companies like Apple and the futuristic tech companies that are going to do 5G and other areas of improvements of technology and software development. So, that whole space is probably going to explode, especially the pandemic will just accelerate the explosion of that as we need to become more self-sufficient.
Well, it's true. We become much more dependent upon technology than ever before. I personally was just totally fearful about running a Zoom meeting. And now I've been in a situation where you've been in meetings with me, right? We've run Zoom meetings where I've got screens all over, 2 mouses that I'm dealing with. I guess 2 mouses in the computer world. Would the 2 mouses be called mice in the computer world? I don't know. We'll have to talk about that after the break. But so if I could become more comfortable with technology, I'm sure a lot of our viewers and listeners feel the same. So when we come back after the break, I want to talk more about the things that matter to you. And really, if you're retired or within 10 years of retirement, what you need to know to protect and maximize your money in this environment, whether John Najarian is right or he's wrong. We'll be back in just a moment right here on The Income Generation. Welcome Welcome back to The Income Generation. I'm David Scranton, here with my good friend and co-host, Jeff Small. So, if John's right with his projections, and he's got a good track record for that, then we have to look at this and say, okay, putting a little money in stocks, putting some of your money in technology stocks for our viewers, for our listeners, is all good stuff. But what if John's wrong? What if John's wrong? There's more downside than upside. Or what if something else happens?
Well, John, Dave, don't confuse the viewers, because John is going to have hedges to protect his downside, and the average pre-retiree and retiree is not going to hedge. And so John is eloquently sophisticated and protecting himself. And so what we do on the show is we teach the viewership and the listeners how to protect themselves. And so the real question is, how do we do that going forward at this market height without really knowing what the true economic growth rate's going to be and what the future holds with the virus? And so we're walking on thin ice here.
Well, of course, as you always say, first you got to get your income satisfied, preferably through fixed income, because stock dividends, you can't really rely on them necessarily. But then, if you're going to be in the stock market, you got to have to keep one finger on the trigger, ready to pull that trigger. And that's dangerous. Stop losses are dangerous because the market could drop. You sell your holding and it bounces right back up. But you could also do what John does, right? We do that for clients from time to time. They want to protect their downside. They can buy options to protect their downside, just like John. So I guess you can have your cake and eat it too, even if you're just your regular viewer, regular listener, right, Jeff?
Well, sure, you can, but I mean, that's, what is it? 70 to 80% of all options trades are losers. And so you really have to know what's going to happen before you make that kind of a decision. You just can't go into it and all of a sudden start making all kinds of money. It doesn't work like that.
Well, it's like buying insurance. 70, 80% of the fire insurance policies are losers for the person buying it because the house never burns down. But you buy the insurance anyway, and so on. But bottom line...
Dave, here's how I feel about what our viewers, our listeners should do today that are getting ready to retire. And I think, they need to focus on investing in their portfolio on companies that are going to be solvent and creating income versus equities based on future economic growth, because those lines are going to diverge. And so they've got to have a balance between those things. And so solvency deals with fixed income and generating interest earnings and creating income in retirement. So I can tell you that every investor that watches this show does not have enough money in the solvency side of their portfolio and generating income. And that is a mistake.
And even if you're buying stocks or bonds, you want to make sure the companies have enough solvency. You're 100% right. It's not about future growth or income. It's about solvency today. So we need to leave it there for now. Jeff, thank you, of course, as usual. And you come back. We'll be right back here in a moment on The Income Generation. I'd like to thank our guest, John Najarian, and also my good friend and co-host, Jeff Small, for joining me today right here on The Income Generation. Most importantly, I want to thank you, our new and returning viewers. Whether you're looking at a short-term dip in the real estate market, a repeat of what happened in 2008, or possibly something worse, these are all things that we just don't know for sure yet. The answers really all depend upon COVID-19 and what happens with our efforts to contain the virus in the coming months. We'll have another major outbreak possibly in the fall or winter, as some health analysts predict, or will a vaccine come soon and start building our collective immunity so the recovery can continue and accelerate? Even in a best case scenario with the virus, how many businesses or industries have already been so damaged by the economic stoppage that they may not be able to ever recover? For now, we just don't know all these answers. What we do know, however, is that Wall Street's reaction to all this uncertainty has been largely one of denial and what I believe is irrational optimism. Yes, there was that initial correction of nearly 40% when the pandemic first hit in March. Ever since then, the market has remained technically in correction territory, meaning down in many cases by a little bit more than 10%, but also recently a little less than 10% from its all-time peak. But since early May, it has consistently been down in the 5 to 15% range. That's bad on one hand because it illustrates the market's fundamental detachment from economic realities. However, it's good on the other hand because it gives investors who haven't done so yet another opportunity to lower their market risk before another drop occurs. I believe this next drop could be more gradual than the one we saw in March and segmented than that because Wall Street's stubbornness has also given advisors better time to analyze what should and shouldn't be sold, as opposed to just the indiscriminate selling across the board that we saw in March. And that's a luxury we didn't have back then. And it could result in higher risk assets getting hit harder this time than more conservative assets. And of course, that's how it should be. Although it wasn't in March, that's how it should be, and hopefully might be if there's another drop. That, I believe, is just one more reason for investors in or nearing retirement to shift their investment focus from stocks and mutual funds to more conservative, income-based financial strategies. So, stay safe, and thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.